Hello, everybody. Welcome. Thanks for having us for this panel today. We will do a short introduction about who we are, because I think it's very important to get a context from the very different perspective we have here joined on the panel. It's 30 minutes. You can ask questions. I will try to kind of integrate them if possible, and basically aiming to kind of give you an idea about how M&A can not only be a way to sell your company and basically create an exit for your investors, but maybe also a tool you want to use to kind of grow faster, or even be kind of becoming part of another company that allow you to kind of execute on your vision. So I'm Peter. I'm founder and partner of 3BC, a Vienna-based venture capital fund that helps companies from Series A beyond. And we have often helped companies either kind of dealing with M&A situations, but also kind of using it as a tool, which I've been doing in my previous job, where I kind of advised also big companies on M&A. So I've seen all the things of doing it right, going it wrong, from different scales, from really 50 people to over 1,000 people involved in the transactions. Let me pass on to Dimple.
Thank you, Peter. So I'm Dimple Patel. I'm the Chief Operating Officer at Truva. Truva is a marketplace for independent bricks and mortar boutiques. We work across Europe. We ship to 50 countries globally across homewares, lifestyle, and fashion. And across my career, I've been involved in multiple acquisitions of different businesses that I've built and grown with different parties as well. Some to secure an exit for the business, others that are very growth-oriented, and last year actually was in the middle of a really high-potential acquisition situation that actually went wrong when our acquiring company went bankrupt 4 months after buying us. So I have also seen some of the more challenging aspects of M&A play out as well.
Hi, good day, everybody. I'm Kristjan. I'm the founder and CEO of Co-Mobility Group. What we do is we build technology for bikes and scooters, and then now we also make scooters and bikes. So we're the only company outside of China to build electric scooters under the brand Daike. I actually had it shipped exactly here at the moment I speak. Miracles do happen. Thanks, Kelly. And I think I'm on stage here because around 3 months ago, we acquired a majority stake in an electric bike manufacturing company in Estonia called Ampler. So happy to share these learnings from this as well.
Thanks. Let me just kick it off. So we have all the different perspectives of acquiring companies, being acquired, kind of repurchasing, being acquired again. I just wonder, what was the motivation of these transactions? Can you give a little context? What was the thinking about, or was it like purely opportunistic, just to kind of set the stage, what the kind of context of the kind of transaction was you were involved with?
Yeah, sure. I'm happy to kick that off. So my first exit was very much a business exit. So that was, we'd grown the business to a good level of scale. I was ready to move on. It was a really good way for me as a founder to leave the company. And that was very clear from the beginning of the transaction. The sale of Truva to Made last year was much more strategic. So we'd come off the back of a huge amount of growth during COVID. We're in the e-commerce space, specifically homewares. But customer acquisition was incredibly expensive. So we were faced with this, a decision between going and raising more money and continuing to invest and build and grow and do it organically, or actually partnering with somebody where we can benefit them through our technology, but also leverage their customer base to leapfrog some of our growth. So that acquisition was very much trying to step change the business, keep that strong growth trajectory going, but do it in a way that wasn't increasingly dependent on VC investment.
Okay. Kristjan, how about you?
I think for us it was opportunistic and strategic. So we knew the founders of Ampler, from the beginning they founded their company. And they were struggling with their cash flow, so they actually reached out to me as a friend saying, hey, where could we fundraise? Do you have any good intros? Do you have any good ideas? Did my best, and then I would say 4 or 5 months later, they were still struggling to fundraise, and then we sat at the table, and somehow I had this idea that, hey, maybe we should invest ourselves as a company. And it kind of, just happened that we had this idea. So we're kind of looking into, helping out friends. But then if I put into perspective, as we had started, building scooters, we already had this vision of building a very strong brand into this area. And if you want to be strong in this light electric vehicle segment, it's not just scooters. It's it's bikes, it's cargo bikes, it's everything else. Yeah. So in that sense, it's really started to make sense. I think we would maybe be like a year or two early in this vision. So okay, let's first launch one product, get to some market share, and then acquire probably another product or build another product yourself. But then it just happened that it was like now you have this opportunity. And I think that's a very, one of very important aspects of these transactions is that you have moments when they happen. I think you don't really plan them ahead. Usually they happen when there's market changes, and it can often be that neither side is totally ready for it. So you always have to be opportunistic to a certain extent, I believe, as well.
I mean, I always hear it's M&A is basically a skill. It's like training a muscle. Yeah. So when you do that the first time, you might do a lot of things wrong. Or what were you learning? So you say, okay, this was really tough, wrong. If I would have known it, I would have made it differently. Or I don't know. You will likely come in a similar situation again. What would you change? Or can you give a little context about how it was and what kind of was challenging?
Yeah, so I actually found there's certain aspects of M&A which can be replicated through multiple deals. So the due diligence process, that is a very important part of a deal. It will vary because obviously no two businesses are the same. Looking back on the situation that we found ourselves in last year, where we were acquired by a publicly listed company. We had access to a lot of information about them. We had run our own due diligence, but 4 months to collapse post-acquisition is a very short period of time. So looking back on that, there was obviously a moment of what did we miss? Should we have picked something up? But when you look at how that played out in the public markets as well, the indicators weren't necessarily there. So I would say for me, the learning very much is looking at things like clawback clauses in SPAs and looking at your paperwork. And, a lot of that will be, particularly if you're being acquired by a bigger business, they will impose warranties and various other clauses within those agreements, but actually looking at it the other way around as well, because whilst it's rare, these situations do happen. And it would take a lot of negotiating. But if I were to go back, I would 100% put one of those clauses in.
How much due diligence did you do on your acquirer? Or would you do more? Because usually people think only the acquirer would do due diligence on basically the company acquired. But I basically say it's also the other way around, is at least as important.
Absolutely.
Was it something you did intentionally or something you would say, okay, we should have done more?
Yeah, so I think an M&A process is always a bit of a dance. So different people have the upper hand at different points. Due diligence, I think a lot of people do think is one way, and I think it is still very much weighted towards the acquirer. But depending on how long you're speaking to them, you do have a lot of opportunities to get a better understanding of their intentions for the business, strategically why it's valuable for them, spending much more time with their management teams, looking at how they operate. They're probably not going to open up all of their books to you in the way that you have to them, but it's really digging deep because ultimately the future of your business is going to be in their hands. So I think push for it as much as you can, but obviously read the room to see how hard you can push.
How was it for you, Kristjan?
No, I have a very good learning just to start from Dimple. It's like, she was on the side of being acquired and she said there's so many paperwork and, pay attention and do a lot of work. Biggest learning we had was that never give the company money before you are legally in charge. So please don't do that. I did that. And why not? Is because if you're in negotiations for a deal and you're talking with a founder-led company, then as long as you're in negotiations of the deal, nobody runs that company. So I think that was the biggest learning I got. And Dimple also said, "Oh, there's so much paperwork. You have to look at this and this and this." And that meant she was not running her company. She was, talking through that deal. And it's just human. Like you don't have that time. And you're as a founder, you're fighting for your rights, for the shareholder rights, for the whole company. Nobody's, managing the company. Nobody's looking at the P&L. And as I said before, usually it's an opportunistic moment. You're usually not selling your company at the moment where everything is super stable or doing really well. So usually you're selling your company where you already had some cash flow crises, etc. And then you're just prolonging that cash flow crisis and the money burns. So why did we give money before was that the company would have otherwise basically, stopped or gone bankrupt. And that would have reduced the value of the company to us as an acquirer in a significant way. So it's a very difficult situation to manage, but I would still somehow build it up differently if I would do it again. And I would really think it through that nobody is running the company as long as we are in negotiations. I think that's the biggest learning.
And just to dig into that, do you think that has to do with also kind of size and situation
Absolutely,
of the company?
yeah. For sure.
Yeah.
I mean, I think if you have a large professional company which is not really that much founder-driven anymore, I think it's a different situation. Because also, if you have a CEO that is not a majority shareholder, then his job is really look at it from the company perspective. But the problem is that if the majority shareholder is also the CEO of the company, then he will more look at it from the ownership perspective rather than from the professional manager perspective. So for sure, if it's a significantly larger company, then it's different. But I think in these surroundings, mostly the companies being acquired or to be acquired are still in this founder-led stage, as we're on the founder stage.
And as an acquirer, you think certain structures, size, etc., needs to be in place? Because it's always, I get the question, when is the right time to think about it? Can I tie it to, I don't know, a certain capitalization, a certain size of the business? What's your view on that?
I don't know. As we said, that for us it was relatively opportunistic. We didn't have a strategy of doing acquisitions yet. I think both of us, we've been too small yet to be in a place where we say, okay, we have cash, we can maybe fundraise easier, and then our job is to grow the market through acquisitions. Not there yet. It was for us the first one. I know you have more experience in that. So I think there are companies who really build the structure and who have a team that just dedicatedly works on M&A. And I think from our side, as the company who acquired, for us, it wasn't that everything else we did stopped. We have professional business unit leaders and all these kept going. But for the other company, it was clear that the company was not run for 4 or 5 months.
And what's your experience in that?
Yeah,
I mean, you
I
sold
think
to a public company, but still you think there's certain size structure needs in place to make that work? Or?
I think it varies depending on the motivation for the acquisition.
Yeah.
So you see a lot of acquisitions where the acquirers are really looking for the product. So they have this option of either buying a smaller company that has the product, has already built it, or they build it themselves. I think in those situations, it probably is less relevant
Absolutely,
how the business has been run, what the structures are in place,
absolutely.
because they probably don't intend to keep it that way post-acquisition. I think if it is a bolt-on strategy or it's a situation where you're going to create a group and actually have 2 companies within that group still operating fairly independently, but financially are codependent, then pieces like you just mentioned are really important because one can create drag on the other. But I think that's really important to determine early on, to strategically, why is this acquisition valuable? What is each side looking to gain from it? And therefore, where is the compromise going to be? And where would you just not move? So I think it is a case-by-case basis. If you are building a company and you're thinking about getting it ready for acquisition, then I think there's a lot of, particularly on the financial side, just thinking carefully about the structures you have in place. Everyone will go through things like your P&L, your cost base, your balance sheets, and also your team and who looks after different parts of the business. Are there clear roles and responsibilities in place? Because those are the basic things that are going to be called out during a due diligence process and could actually also then break a deal.
Maybe one thing I wanted to add, I think would also kind of just everybody would think about it, that most acquisitions, I think, in the startup world, okay, if it's not like Google buying a small company, if it's relatively medium and small size companies, I think most of these acquisitions actually happen through share swaps. So money, there's not too much money that moves. Actually, you know, the smaller company gets shares, or the owners of the smaller company get shares in the larger company or the bigger company, and that's also where you can build a lot of structure and how do they get the shares, or how they vest them out, and etc. But also on the other side, I think you have this great experience where you got a lot of shares, I understand, and 4 months later the other company was in bankruptcy. So always try to find, you know, this medium ground from both sides, that there's potentially some cash that works around there as well. But for the acquirer, if the other company is in trouble, there's also this point that I understand that there could be some cash that moves, but actually the company needs cash to survive. Right, so I think usually in these deals there is not too much cash moving at that moment of time, and so you also have to look at the longer perspective, because also these people you will be on your, you know, ownership list afterwards, on your cap table.
I mean, we talked about reasons of capitalization as an advantage looking for, or kind of increasing or completing the product portfolio. But I mean, people play an important role because you acquire a company and organization is people. What were your experiences with that kind of integration, bringing often two cultures together, making sure everybody also on both sides stays motivated? What did go wrong where you say, okay, we did right on certain things? What were kind of your experiences kind of managing that kind of whole integration and making sure everybody is kind of aligned, thinking in the same direction in the end?
No. We had a very difficult experience actually, is because we acquired only 51% of the stake. So we have a majority shareholder, they're part of our group. So you know, you consolidate the revenues, etc. But actually legally, you can't consolidate the companies because they have different ownership structures. So when the deal was kind of signed but not happened yet, we already had a joint event. So twice a year our group has this strategy days event. People all come together from all around Europe and we have a big event. And we had a joint event with this new company. It was extremely positive. Everybody was like mega happy. You know, it's a new beginning. You know, let's challenge and conquer the world. But what happened after that was that everybody got this huge, you know, motivation boost. But then they went back to their, you know, daily routines, and we couldn't join the companies really because they have different legal structures. So this is something I would really try to avoid in the future, because it creates this weird limbo where you kind of are like one, but you can't fully put them together because you have to have different managements and different bookkeepings and etc. And it really, I think, has a toll on people. You know, you kind of don't understand anymore like who's your, you know, where you really belong to. So this is something I would avoid, and I would really, from day one, try to, you know, join the cultures, join the people as much as possible. What we have done, what we have been able to do, is we've now killed, you know, separate offices, so the people actually sit together and, you know, live in the same office space. So on a human level, it's the same contact, it's the same, you know, people, but in the way how they do business and structure, it has to be different legally, and that's quite painful.
Okay, thanks.
Yeah.
How was it in your experience?
I think we probably had the opposite, actually. So when we were having our initial conversations with MAID, looking at cultural fit was really important to us. So we have a very, very strong collaborative culture at Truva. It's how we move so quickly. But we did find that with them. You know, for all of their operational issues as a team, they worked really well together. So we actually put the integration of the teams and the people quite high up the agenda in terms of the post-merger integration work. And that was things like when we built a strategy and we had shared projects, so really leveraging those synergies, we accelerated them in terms of the timeline. So we brought our people together, we built squads, we had them working across companies but on the same project, really quite early in that timeline. We moved into the same office space. So there was that kind of communal, you had the water cooler moment. And actually what we found was it made that integration process much smoother. You got everybody's buy-in, everybody wanted to make it a success. But also when things didn't work out. So when MAID went bankrupt in October, and we were in a situation where we were pulling Truva out of that, and we were taking it independent again, and we were running a fresh M&A process, even people on the MAID side were there to support. They were like, how can we help with that? What due diligence are you working on? Are there any materials that we can provide from the project? So regardless of how these different projects play out. If you have your people on board, you're much more likely to make it a success. So I would say, whilst overall it was a bumpy ride, I would echo that actually bringing the people together really early helped.
For us, what was really weird was that people really loved to be together and work together, but really kind of struggled with this legal procedures, that in some things we just had to say, hey, we can't do that together because we're actually still separate companies. So that was tedious. I think from cultural point of view, things actually accelerated really well. And I think that's the thing. If these acquisitions or these M&As, they make sense, then I don't think matching cultures is too difficult. I think matching cultures will be difficult if somebody felt that they, were really, acquired in a weird way or in a not fair way or something like that. But if they strategically make sense, if the deal makes sense, I think both parties are happy to work together because both of them grow, kind of in a flash, and both of them are now we can do more.
I think, in my opinion, it often is dependent on the size of the companies or relative to each other. So I've seen different strategies about acquiring only really small teams, like, I don't know, an Oracle or Apple does it a lot, or kind of looking at more kind of bigger strategic integration, where I think that topic, bringing two cultures together versus just being swallowed, might play differently out. I got a question from the audience asking about if M&A you see as a way of saving your company, and I just want to hear your kind of opinion on that question. If, as in target, that might be a feasible strategy. As an acquirer, I don't know how much that plays into role. What would be your view on that?
So I think you will have a very interesting answer to that question. But from my perspective, it depends on what you mean by saving your company. If you're talking about, well, can I make sure that my company still exists in 6 months' time? Potentially, but there's never a guarantee that the person that's acquiring it isn't going to strip it for assets, take what they need, and then shut the rest down. I think if you're looking at it from the perspective of fulfilling your obligation to your creditors and your shareholders as a director of the company, potentially, but the question also is on what terms. I think if you are in a situation where your company is struggling, your cash flow is really stretched, and your burn rate is really high, then I don't think there is kind of a golden bullet, a silver bullet at that point. I think it is really just exploring it as one of the options, but I think your expectations need to be quite realistic about the kind of acquisition and the kind of partner that you're going to get at that stage.
I think, why do you acquire something is of course to gain from it. And if you bring this example of Oracle or Google or Microsoft, they acquire because they're not as innovative anymore. So they acquire those innovative product teams to get new products to make their company better. Marcus Willig was on this stage from Bolt. Some of you know that he's on a shopping spree. So why is he on a shopping spree? It's because they have a clear plan to IPO, right? And what does he do, and what did we do with the acquisition, is that we have a valuation. Let's say our valuation is 100, and our revenue is, let's say, 20. So your revenue multiplier is 5. So if I do 20 of revenue, I get 100 as a valuation. If there's another company who's struggling, their revenue multiplier might be, less than 1, or really, really small, because they have this moment of difficulty. So now if you acquire that company and you add yourself a revenue of, 10 or 20 million, your revenue multiplier should still stay 5. So basically you're paying somebody, 5, you get them over, and then your valuation just jumps huge. You're going to win 20 times because you keep your revenue multiplier, but you just add so much revenue to yourself. So that's the whole deal of doing these M&As. And you say, does it save your company? Then if your company needs to fundraise, and you want to boost your valuation, you want to boost your attractiveness, you want to boost your scale, it's a way how to do it in a very quick way. It's kind of a hack of growing faster than you could. And why Marcus is on a shopping spree is because he wants to IPO. If you IPO, you want to show that you have a huge revenue. So what he does is that he has a very good revenue multiplier, and then he goes and shops and buys the companies who are struggling. And to a certain extent, it might not even make huge sense mega long term or even mid term, but short term he just boosts up his own valuation through acquiring revenue.
I hope that's not the only reason, I have to say, because that might backfire.
No, of course. But your question was about saving the company. So if you need to fundraise yourself, it's a way of a hack for the acquirer to show that you're bigger, better, and more beautiful, so you can fundraise to survive. You know, it's a moment, for example, I'm not saying that that's exactly what we did, but it's just a moment of that, hey, I need to fundraise, I don't have a very sexy story, maybe I can buy, you know, other pieces to my story and then better fundraise. So it's like, you know, taking another risk is like, should I, you know, reduce my costs? Or should I just go full on and, you know, go forward and even take bigger risks through other companies? So.
I mean, just to complete that, I've seen also other strategy being at play, like internationalizations. You want access to a new market, that could be a good reason for doing it. Completing a product, acqui-hiring, of course, often a topic you want to have.
But this could be the same thing, is that actually you really need to show growth, you really need to, I don't know, fundraise, and instead of taking 5 years to grow to international market, you buy somebody quickly, right? And then you get your story full. So if you ask, can an acquisition for the acquirer be there to save his company, then surely yes, I think so.
Interesting point, yeah. Just on the, because we're running kind of to the closing, if you would do it again, what would you change? And you already mentioned, Kristjan, in the beginning, like, okay, always make sure you have control before wiring money. But aside from that, is there anything else you kind of want to share with the audience?
I don't think so. I don't know. I think that was the main thing. That was the main learning. I would still do it. I mean, I think you still should put the strategic goals in front. So, like, even if you made a mistake financially short term, if you can come out of it, then it really has to make sense strategically and in the storyline. But yeah, I wouldn't say that there's more learnings than don't wire before the deal is done, and make sure that that you understand that if it's a founder-led company, the company will not be run until you have the negotiation process. And if you have this knowledge, I think you will really do everything possible to minimize the length of the negotiation process. I think it's minimizing the length of the negotiation process I would also really push for.
So I think for me, definitely the clawback clause. So really digging through warranties that you're giving, but also what you can negotiate to receive. I think that's very, very difficult, and it depends on who has the upper hand in some of the negotiation. But particularly if you have a really, really strong product, potentially there's something to be done around things like licensing of that product, maybe just stagger the way in which things are handed over. I think there's definitely room for creativity, particularly in this sector where there is so much innovation, and you get bigger players coming in looking at buying those products because there's something really magical or really, really smart about them. Don't just give it away at the drop of a hat. So I think whilst a lot of people focus their negotiations on valuation, and there's definitely an emotional aspect attached to that, go through the small print, look at the longevity of the transaction, and also what it means for your business afterwards as well.
Thanks. Just to sum it up, I think what I took away from your experiences is like, it's a lot of like doing your homework properly, sticking to kind of a process, really kind of know what you want and push for that, yeah, and not kind of give in for easy solutions. I think it's training a muscle. I think you get better every time you kind of do it. Yeah. It can be opportunistic, but I think it's also interesting to think about it as a strategic tool. So not only on the financing side, but also you mentioned on the growth side, how can you increase my kind of market share, my valuation, getting ready to kind of an IPO or different ways of financing myself at a cheaper cost. So I think some interesting learning here. You will be around, I think, yes, for people to question. So thanks a lot for the opportunity to share our thoughts with you, and up to the next.
Thank you very much.
Thanks.
Up to the next acquisitions.
Yeah.